Well, they're calling it a cost of living crisis, as we know, and we're all feeling the squeeze, be it in food prices, petrol prices, the cost of heating, of course. But in particular, mortgage rates have seen a sharp increase in the past couple of weeks. So let's take a longer look at what's going on. And Whole Mortgage advisor Malcolm Davidson runs UK Moneyman. He joins me live on the programme this afternoon. Good afternoon to you, Malcolm.
Hi, James.
Thank you for talking to me. So you've talked to Andy, you've talked to Bernsey since the mini-budget, reflecting on where we are at. Bring things up to date in terms of the mortgage markets, in terms of where people's confidence is right now. Where is it?
Well, in those first few days, the headlines were that the banks were pulling the mortgages, and that was true to some extent. The lenders were a bit spooked by everything that was going on. I think it was a bit of a political error that the Office of Budget Responsibility weren't allowed to make their usual statement around budgets, or as this was called, a fiscal statement. And no one kind of knew where they were for a few days until the Bank of England stepped in the middle of the following week and bought up some bonds. So very different to 2008 because unlike then, the banks are very well funded, they've got the money, they want to lend it, but they had no idea for a few weeks, or a few days, sorry, how to price those mortgage products. So they withdrew them from the market to take stock, and obviously almost 2 weeks down the track now, the lenders are back lending. Unfortunately, for your listeners and for all the other consumers out there, the rates of interest that have returned sadly are much higher than the ones we've been experiencing for the last decade or so.
I mean, that must be a shock to people like you who've been supplying people's mortgages for years. But certainly in the last 10 years, you've been able to get people very, very good rates. And I should hold my hands up here and say I am one of your customers, so I do know. So just in case of any kind of conflict of interest here, you were my mortgage advisor a couple of times, so I know what rates.
You sound quite happy, James.
Can I just say I'm relieved more than happy. It was gone from happiness to relief. But I know from experience of coming to you that you've been able to get very small rates. Is it a shock to the system now that those rates aren't available and you're having to have those difficult conversations with house buyers?
Well, I suppose we all knew that these low interest rates would come to an end one day. I've been doing the job 25 years, so I do remember the double-digit interest rates, James. So this day was always, this day of reckoning was always going to be coming at us. But what the shock was that it was all so sudden. So from being quoting interest rates of 3.5%, 4% rates had been on the rise, remember, all through 2022. But this jump up to where we are now, which is interest rates in the fives, and in some cases over 6%. It was the speed of the change, and I think that caught everybody by surprise. So there's been some concern out there. It'll have some implications in the market, but in terms of how it affects us in the business, well, we don't set the rates here. It's the banks that set the rates, and what we sell is mortgage advice. And of course, on that note, we've been exceptionally busy these past 2 weeks trying to field people's concerns. It almost feels like anyone that's got a mortgage, needs a mortgage, has ever had a mortgage, wants to reach out and have a conversation. And that's really what this is all about in terms of providing the service.
One thing that happened in the last couple of years during the pandemic was we saw an incredible shoot in the cost of house prices, and houses were going up and rocketing up to huge levels, really. Is that slowing down now?
I think that's inevitable, but to put that into perspective in terms of that spike, and obviously that was fueled to some extent by the stamp duty holiday that the government gave in 2020. We've had a 20% rise in property values since COVID. I mean, that is just not sustainable, okay? And if things were to continue at that pace, then it'd be very, very, very quick for first-time buyers to become priced out of the market. Now, this isn't me trying to scaremonger or suggest a crash at all. That's not what I'm suggesting. What I am saying is prices can't continue to rise at that incredible pace that we've had over the last 2 years. And if there is a correction, if prices start to level out, grow more slowly or even reduce slightly, then that can be welcomed in terms of people looking to move up the property ladder or first-time buyers. So yeah, a slowdown is almost inevitable because people won't be able to borrow as much. In fact, the banks won't let you borrow as much because they're now doing their affordability assessment based on our new world of these higher interest rates. So what you were able to borrow 3 months ago might well be different if you were applying for a mortgage today.
The one thing we did see in the last couple of years was in some parts of our area, houses would go on the market, say, on a Monday and would be sold. Well, at least the sold sign could be on by the Friday in terms of offers being accepted and that kind of thing. And in some cases, houses didn't even get to the for sale board going up because there was that bigger waiting list for properties. Is that still the case now after the last couple of months, the last couple of weeks?
Incredibly, yes. Incredibly, yes. I think the top end of the market might be more affected than the lower end. Because if you think about it, James, if you've got a first-time buyer in rented accommodation, what other options? You know, they could stay renting forever. But as long as a mortgage payment is comparable to rent, then most first-time buyers would still continue to prefer to buy. And there's lots of them out there. I think a lot of experts that you listen to and see on the TV underestimate the massive mismatch between supply and demand. As everyone acknowledges, we don't build anywhere near enough houses in the UK. We haven't done for years and years and years. In fact, you might argue since the 1950s, really, we constantly miss the housing target. And the new Prime Minister is actually considering scrapping that target because it's almost become meaningless now. So actually, we're still finding competition for houses, especially at the lower end of the market, and things are still selling quickly. But you know, as for next year, a slowdown really has to happen, and if that happens, I for one will be quite pleased if things become more affordable for those people trying to take the first rung on the ladder.
So if we've got people listening who are either remortgaging or perhaps listening to this about to begin that process of buying a house for the first time, or maybe the parents, the grandparents of those who are becoming first-time buyers, what tips have you got for people right now in terms of making this market, making these increased mortgages, the cost of mortgages, work for them?
Well, if we just take it section by section, so first-time buyers, it's really important that you get an agreement in principle before you start viewing houses, because you'll be affected in terms of the affordability assessment. So you need to know how much you can borrow before you start viewing houses. That's how they're affected. Home movers, I think we're going to see more potential home movers not actually doing that over the next 6 months, because if they're happy in their property, unless it's a forced move because there's a baby on the way or there's a job relocation, I think a lot of people will stay put and wait for the dust to settle. That's kind of a typically British thing that we do when we're not quite sure of the economic situation. Those that are more immediately affected are those people whose mortgages are coming to an end in the next 3 to 12 months, because they're probably going to be coming off a rate of interest, maybe 2%. And as it stands, looking at something significantly higher than that. So they need to be making plans to remortgage, check with their current lender what deals are available to switch, and also go to the market as well to compare what's out there, and not leave this till the last minute. They need to be looking as soon as there's 6 months or less remaining on the current mortgage deal, because you can lock in now up to 6 months before.
Malcolm, really good to speak to you. Just very quickly, there was the question time on BBC One a couple of weeks ago where somebody, a young house buyer, in fact she was a first-time buyer, she talked about her personal experience and said she'd been offered a 4% mortgage, and because of the uncertainty, her lender had switched that and offered a 10% instead. Not necessarily without, because you'd have had to have seen her, but I know her circumstance clearly. But is that something you're hearing, that those kinds of staggering figures are common, or are they not so common across the piece at the minute?
Well, I think your caveat is right. We don't know what her particular situation is. It could be that she had some credit issue. I did see the clip, but we've not seen anything like double-digit interest rates, James, for over 20 years now. So the rates on offer are somewhere upwards of 4%. 5% and some in the early 60s, so nothing touching 10% at this time. That's the fixed rates. Actually, the trackers and variable rates are significantly lower. So if you're prepared to take a chance on rates continuing to rise, and that would be affordable if they did, then you're looking at a rate between 3 and 4%. So those are very much coming back into vogue for the first time in the last 10 years or so. Typically, 90% of people were fixing until now, but people are starting to consider these floating variable rates of interest, and keeping their fingers crossed that things become under control and inflation comes back down next year.
Malcolm, good to speak to you. Thank you for joining me. That's UK Moneyman Malcolm Davidson, who is based in Hull. BBC Radio Humberside.